Okay, so what I
Yeah.
know right now about float that I didn't understand before is that its low float is going to be indicative of high volatility. And that is ultimately one piece of the evidence that I want to look for if I'm trying to build a case for what stock I'm going to play. Welcome to the Study Trade podcast. Today we're going to do some short episode series. Stephen is going to teach me a little bit about the number of variables that I want to keep an eye out for to determine if the trade is going to go forward or not. I'm still a baby trader. I haven't begun yet in so many ways, but today I'm going to get some basic overview thanks to Stephen. So I hope you enjoy this episode.
Yeah. Welcome, Kim Ann Curtin, co-host. You electrolyte my life. Not electrolyte, you electrify. You electrify my life.
Electrolyte is pretty good too, actually. It's like
No, electrolytes are a component. Electrolytes are nutrition that fuels energy.
it gives you energy. Yeah. All right.
But
So
electrify is a verb.
I did my homework. You told me to do my homework on variables, and these are the variables. This is when my understanding is I've begun watching Tim Sykes's course, and he talked about the SSS, building the Sykes slide. What is it? Sykes sending.
Sykes yeah, I mean, so basically, no matter who is your guru, no matter who the guru is, and there's some furus out there, and you don't listen to the furus. And I got some hate off a furu. He's not a furu, he's a guru, but he's a bad guru. I got some hate off him on Twitter, but we'll not talk about it. But basically, there's a lot of gurus.
Yeah.
Go on.
Go ahead.
There's Tim Sykes and there's Tim Bohen. Tim Bohen calls it building the case. Tim Sykes calls it the Sykes sliding scale. Both are metaphors for the same thing. It's basically how many variables can you stack in front of you that are either pro-bull or pro-bear to build strength or weakness against your case to go long or to go short.
So it's like a defense attorney or prosecutor has to make their case before the judge and jury. So we have to
very much. That's
decide to run with something.
No, that's a sick metaphor, Kim. That's a sick metaphor. It's a very real metaphor and it's a very visual metaphor, and it's true. And I just think if it was O.J. Simpson, not that I have an opinion on it, but it's like O.J. Simpson. It's hands in the air. Did he do it? Did he not? And it's like, how much can the prosecutor build a strong case one way, and how much can the defense build a strong case the other way?
Oh, he didn't build a strong case, and that's why he was acquitted.
But he had a. Yeah, well, I'm not. We'll not go into it.
Well, I mean,
I have opinions.
I'm just saying, at the end of the day, if you don't build a strong case, then people do get acquitted. So the concept is, that this is why this is so important. We have to build the case for ourselves to determine. All right. So
the case,
tell me. You told me to look. Go ahead. What were we going to say?
I just want to say one more thing. I want to say that when you're in the courtroom, when you're in the law of court and the hands on the Bible, what you're looking for is extreme convictions. Either someone is very guilty or they're totally innocent. Mm-hmm. And in the exact same way, trades are taken the same way. It's either a very, very good long or it's a very good short. Mm-hmm. And these are a trader's dream. These absolute convictions are these absolute mistakes where someone will be rebuted. Trading's the exact same way. You need to look for the cases where it's extremely one way, and that's how the evidence or the
you don't jump in.
No, you need every single point of evidence to point towards it's a long, or you need every single point of evidence to point towards it's a short. If it's unsure, if you're like, Some variables are positive, some variables are negative, some variables are guilty, some variables are innocent, some variables are long, some variables are short, then these are a trader's worst nightmare. You better to stay away.
So that is part of the reason why, even I've heard, Tim Sykes say in the courses I'm listening to, there are times when he's just not going to enter at all. And that's why sometimes people will go a day or two
Yeah.
to not, because they don't see these opportunities all lined up like you speak to. And so that's why it's better to just wait another day, see if you see it, and wait until you see that
No,
absolute
but
absolute guilt.
that's absolute go to prison for 100 years. Like, but what you don't understand, and it's so easy to talk about it in practice, and that's what, and it's so easy to paper trade as well, and that's why paper traders are winners and real traders are often losers, because it's all about the emotional psychology, which you're an expert in. But the trouble is, like, I mean, for me, the other day, I went on a hot winning streak, took a $200 loss, and then there was no trades the next day. And I didn't think no trades. There's not a guilty case. There's not an extreme innocence case. I didn't think like that. I thought I've been green all this month. I've had an insanely good month. I want to keep winning.
Yeah.
And I lost $800 doing trading a long when I'm not a long trader. I'm a short bias trader. I've never longed probably twice this year.
Wow.
And one of the times was my biggest loss of the year. And it's about the emotional roller coaster, and it's fine. It's okay. It's not the end of the world. But it's about managing and controlling emotions. But that's for another day. But
Yep.
I just wanted to mention that it's not black and white.
Makes sense. Makes sense. All right. So today's topics,
So
we're gonna do a collection of 6 variables, but today we're gonna talk about
yeah,
2 of them.
I'm
And
gonna say pieces of evidence, and I want you to say pieces of
All
evidence.
right,
We're in
pieces
the
of
courtroom.
evidence. We'll get out our, what I'm trying to think of, what Matlock or like all these different TV shows I watched when I was little that are way before your time, because you're such a young whippersnapper. All right,
I'm not so young, but
float
go on.
and daily volume are the 2 topics. This is what I understood a little bit about float and daily volume. I'll speak to what I understood it to be, but then I have some questions. How does that sound?
Yeah, let's break it down. What is float? What is volume?
So I understood float to mean it's the amount of stock that is practically available for trading.
Did you? Is that your definition or is that Google's definition?
Google's definition.
Okay, what's your definition? The same definition because you read it. I guess you
Yeah,
read it from it.
except I really didn't know what that meant by the practically available. I understand. So
Yeah.
okay, let me say the daily volume second too. So I understood daily volume to be the number of shares that are actually trading hands in a given day with a real buyer and seller.
Now, when it says it's practically available, so a company has a market share, and a company has it has a market share and it has a float. The market share is what is publicly. It's what's publicly and privately available. So, like, say, and I'm not the best person to explain Tim Bones better, but say it's a 10 million company.
Mm-hmm.
$8 million could be owned by insiders.
Right.
So that's 8 million. 8 million's privately owned. But the other 2 million is publicly available for traders to buy and sell. And that 2 million is the float. So when they say it's the available, it means the available to trade. It means what's publicly on the stock market to trade. And that's whether it's on the NASDAQ, the SPY, or the AMEX, or the Russell 100 or whatever.
Okay.
Whatever market it's on, the float is the available number of shares that can change hands by the public, not private or institutional investors.
Yep. And so volume uh, is the volume different than, well, I'm just looking at my question here. Is volume only known at the end of the day, or is it able to be interpreted as the day goes forward?
Nah, dead. Good question. because it reminds me of something that not many traders know. The volume is ongoing. It's live. It's like a human. It has a heartbeat. But now it stops at the end of the trading day, and it's after hours, and it starts pre-market. But volume starts 4 a.m. New York time. It
4 a.m.
really kicks off. Yeah, I mean,
4
you
a.m.
have pre-market. Early pre-market is like 4 a.m. Yeah,
Uh-huh.
but then like the real pre-market is like 7 a.m. But then the stock lights on fire at 9:30 a.m.
Yeah.
It ignites if it's a heavily traded stock. And then at 4 p.m. 4 p.m. the market closes. And then like 8, I'm on Dubai time, but I think at 8 p.m. The volume is officially recorded for that day.
Okay.
But what's really important to stress is traders are always looking at volume as an indicator of what the stock might do a previous in the future and in another day, and they look at float and volume in different ways. But let's just define volume, and then we can get into that. There is actually so much to talk about; it's ridiculous. Volume is basically the number of shares traded by the public and private institutions, I believe, in any one full given trading day from like 4:30 in the morning till 8 p.m. at night.
So if
That is
I'm
volume, the
going
number of
into
shares traded.
trade in the middle of the day, am I looking at the volume for the previous day and having that inform the interpretation I think the volume of that day I'm trading is?
Yeah, so I think the way to tackle it, we started with float, so let's go with float, and then we went to volume next, so let's go to volume, and then the final thing is to talk at float with volume in tandem and synchronization.
Okay.
So this is a kind of a beginner episode a little bit, but I think there'll be nuances and things that some of the more advanced traders can take out. So first of all, with float, you're looking at. Do you have a question related to float that you want to ask? Or
Let me just finish reading here. So, right, I have low float stock are relatively low numbers of shares that are available to the public. They have higher volatility and price instability. And at float, it says float is calculated by subtracting the closely held shares owned by insiders, employees, and company owners.
Exactly.
But what I'm curious about is how is that calculated? Are you calculating it? Is somebody else calculating it that you're referencing?
No. Basically, there's a market capitalization. The market capitalization, or market cap as it's known as, is the total number of shares available in the company. The float is the publicly available tradable
you
shares.
That out with your calculator, or
no. If you go on StocksToTrade, if you go on StocksToTrade, if you go on Yahoo Finance, they'll say and generally it's like they're like half of each other, or they're like 80% of each other. So like the market cap's 12 and the float's 10, or the market cap's 10 and the float's 7.
Okay.
So like if the market cap's 10 and the float's 7, then there's 3 million shares that investors hold, and there's 7 million shares that are publicly available to trade. Market cap doesn't matter. It's all you care about is the float. How many shares are available to trade?
And ultimately, based on the pattern that StocksToTrade is advocating, what should that look like? Do you want it to always look pretty much the same? Are you always looking for a particular number or
what do you say when with pattern, and what do you say with pattern and number? I'm not sure. What do you mean by pattern and number?
Well, are you looking? You just spoke to a couple, so are you looking for a specific amount that within a couple of
Yeah. Okay. Yeah. So if you speak specifically about float. For me, I group floats into 3 categories. I group floats into low float, mid float, and high float.
Okay.
A low float, it's changed over the years because I've got more aggressive as I've got more knowledgeable. But a low float is under 10 million shares. If there's 10 million available shares to be publicly traded or less, I'd group that as a low float. Because if there's less than 10 million shares and the best way to explain it, and we'll go back to some basics, is if you had if you had like lemonade, say you're a 12-year-old girl, we'll go back to your former self. If you're a 12-year-old girl and you go back to your former self, and it's a hot sunny day, and you have like 20 liters of lemonade, on a hot sunny day, you're gonna sell a lot of lemonade because boys are out. It's summer. People are playing football or American football or whatever. It's gonna sell. So if you have 20 million shares and it's a summer day, it's gonna the supply versus demand is gonna rocket.
Yeah.
Do you know what I mean?
Yeah.
But what if you only had like 1 liter of lemonade and everyone wants it?
Yeah.
It's gonna go even higher because the demand massively outweighs the available quantity.
Lemonade.
So that's just an analogy I just want to put in there.
Yeah.
So on low floats, say a low float's 10 million shares. If any low float with 10 million publicly available shares or less is high in demand, it will skyrocket. If it's that hot sunny day and you've got the lemonade, you're gonna sell it, and you're gonna sell it for a high price because it's supply versus demand. The mid floats are more like 50 million and under, 40 million and under, between 10 million and 40, 10 million and 50 million. They're more like England. It's windy. It's not that hot. But some people still want lemonade. Do you know what I mean? Because everyone likes lemonade. Yeah. But you're not desperate for it.
Yeah.
So unless it's an extremely, extremely sunny day, you're not gonna like rush to buy that lemonade. And the higher floats are they are your bigger companies. They're like 50 to 250, 300, 400 million floats. Sometimes like billion, 2 billion, 5 billion, 10 billion market caps. And the major difference in float is that the low floats move fast and they're volatile. The high floats move slower and the less volatile. But any given stock, given the right news, given the volume, which we'll get into in a minute, can still move.
I thought in general we were being that all of the books I'm reading and listening to Tim Sykes and Tim Bohen was that we want to find the high float stocks.
No,
So
I don't know. I don't think it's the opposite of the teachings, I think.
Okay. So ultimately, we want to find those that are the low float.
No, it depends. I mean, it totally depends. But you definitely don't want high float. You don't want high float stocks, no. Like the only high float stock you'll ever trade is Tesla. Tesla's gone insane recently.
Okay.
But it's the only high float stock that's ever done so. No, you as a trader, you want volatility.
Okay. So high float would be the antithesis of volatility.
Yeah, pretty much. I mean, Tesla is the anomaly because Tesla's gone crazy recently. But any high float stock can only move 1%, 2%, 3%, 4%.
So I think that's a huge distinction that I probably didn't have because I probably was associating high float with high volatility. But what I'm hearing is high float actually equals low volatility.
No, like and this is I'm really, really closely teaching one of my best friends out here. He's got a little girl and a little boy. They're beautiful children. I love them to death. And he's an amazing guy as well. But he wants to make money, and I'm like, dude, I can, please let me help you. And yeah, I'm teaching him right now, and he's going through the same steps as you.
Yeah.
But yeah, it's very important to remember, and I've told him this as well, that you want to be going for the low float, high volatile stocks because that's where you're going to make the gains.
Yeah, I think I just somewhere misunderstood what the high and the low adjective before the word float meant, and that's what to distinct. That's why these conversations are important, so I can get these distinctions.
Yeah.
And again, with regards to the calculated float, if you, let's say if you're looking one day at one particular stock and you're leaning towards it, but you don't see all of the case, you don't see all of the evidence, and then the next day, are you going to look again at the float? Is the float going to change it's presumably changing all day long. And
No, it doesn't. It does not. It does not.
doesn't.
The one other thing that I want to say is my friend was terrible at maths because he saw me calculating different risk rewards and patterns, and he said I'm rubbish at maths. I'm good at art. And I said, Tim Sexo said you don't need to be good at maths, and it's true. You don't need to be good at maths at all. That's an important thing. But the question that you asked is, does the float change and move? And the answer is that no. Once you've made a direct analysis of a stock, then you don't really need to make an analysis of the stock again. The float will never change. The only time the float will change is if the stock do an offering to sell more of the company for a specific price, which would then dilute the float. So say, for example, a float is 5 million. These rubbish penny stocks that are very terrible companies, they might say they will push the stock price up with good news that isn't really good news. It's hype and fabrication. They'll push it up, and then they will sell, and all of a sudden they will say, by the way, we are selling, say the float's 5 million, they will say we're selling another 5 million shares at whatever price the stock is, and then they get the money from the 5 million shares they sell.
Got it.
So then they'll make enough money to continue operating, but the float will change from 5 million to 10 million. But but that doesn't happen often, and if you do, you get a lot of warnings in the SEC filings. So the answer to your question, and I'm sorry it's long, is nothing changes in analysis other than news if it comes out the next day. That's it.
Okay, but let's say you're looking at is it going to change at all over, let's say, a week? Let's say you look at something and then a week later you come back to it. Is it possible that changed?
Nah, float will never ever change unless you get like a pre-warning about it. And the only time that you'll get, like, they'll either do, the only time the float will change is if they do a reverse split or B, an offering. Okay. And you kind of get warnings about both of them, but no, it doesn't really change. If it's a reverse split, we'll go into reverse split another day, but offerings is when the dilute the float.
Okay. All right. So we should wrap it up there since we said we'd only do about 15, 20 minutes.
We haven't even talked about volume.
All right. Well, we have to talk about volume. So talk about it. Tell me what I need to know about volume. Daily volume or volume? Is volume and daily volume the same?
Like volume can be shown.
Not, by the way, it's not. It's,
sorry.
The chicken is still the rooster. I have the rooster.
I don't know. I don't know what that means. I can't hear anything.
The rooster is outside my window. You just hear him cock-a-doodle-doo. Okay.
No, your mic is good. It's blocking it.
Okay, good.
So you understand float 100% now?
No, I'm not 100%, but I'm better. I'm like.
What? No, let's just close this at float. But you tell me what you understand about float, and we'll close it with the confirmations of float. And then we'll do volume tomorrow.
Okay. What I know.
Not tomorrow, but
another time. Okay. So what I know right now about float that I didn't understand before is that its low float is going to be indicative of high volatility. And that is ultimately one piece of the evidence that I want to look for if I'm trying to build a case for what stock I'm going to play.
Yeah, but it depends. It depends very much on biases. But you have to learn this and you have to piece it together. If it's a low float, it's going to be volatile. So it depends on a number of different factors. Say a stock is up 150% on the day and it's a low float. That means even though it's up 150%, it can still be extremely volatile because with low floats, like no one's up and no one's down. Say the float is 1 million and the volume's 1 million. That means that everyone who is trading the stock is in at more or less the price of that day. Do you know what I mean? I know.
No.
Okay, so let me explain it this way. If say for example, I bought, it's February the 5th right now. Say I bought a stock at $10 and the float is 100 million. and everyone else bought the stock at $10. So 100 million shares all traded at $10. Okay.
Mm-hmm.
Then say a month later, the stock price went down and down and down and down and down. And everyone was trying to get out at 9 and 8 and 7 and 6 and 5. So if the float's 100 million and 100 million shares were traded today in the 8s and 9s and 10s, that means 100 million shares worth of people are all stuck with losing positions in the 8s, approximately. Do you understand that?
Yep.
Then months go by and the stock doesn't trade any volume. And it's now in the 3s, the 2s, the 1s, because it's slowly just dissipated and fell apart.
Yeah.
Yeah. The next time that it spikes to say 3 or 4 or 5, there's 100 million shares worth of people who are stuck at 8. So you know that the next time it spikes, it's a potential short, because 100 million shares worth of people are in it at 8 and they are desperate to just get out at 3 or 4 or 5 and cut their losses.
Yeah. Okay.
Does that make sense?
It does. It does.
So there's a big selling pressure. But on a low float, if the float is 1 million and a million volume trades, the float is rotated. No one is up, no one is down, everyone is the same. So a low float makes it more of a crazy gamble.
Gotcha.
Where with a low float, you can gauge where people are in the stock.
Okay. Did you start out when you began looking for one particular pattern that you then felt comfortable with? Like, do you advise us to at least initially look for this pattern and that only? Or do you before you can look at the whole landscape, I'm presuming you go into it with a couple of things you're familiar with and you're looking for those things.
Yeah, it's a crazy question, because it's hard. I'm happy and I'm sad, because I'm happy that I have the knowledge to not be in the space or zone anymore, to have learned the game and crafted the game. But I'm sad that I feel like maybe I've lost touch with many of the new people who are learning trading for the first 1 or 2 years, because I don't realize I miss the curiosity and the intuition, and I miss the fact that I don't think this way anymore. But I used to, and but the pattern I look for is always the same.
Yeah.
It's always the same. It's an overextended gap down, or it's a gap and crap. I look for 2 patterns, but like 100 different variables determine that pattern.
Yeah.
So it's a hard one to answer. But could you repeat the question and I'll try and answer it?
No, I mean, I think there is, you are sort of above looking down on the landscape from the top of the mountain, and I'm still in the weeds. And I think that's, this is part, I think it's hard to ask somebody who's now on top of the mountain looking down to be in the
Shouldn't
weeds.
be though. No, but it shouldn't be. It shouldn't be. That means I'm turning into one of those professionals who don't understand new people anymore. I don't want
No,
that to be.
I think you understand new people. And if anything, just think of it this way. You're having to teach me, and that colleague of yours will, put a gun to your head to be able to help us understand the weeds. But we better
No,
close
but
because we're probably going way above our 20-minute segment.
okay.
What do you think?
Yeah, I would just say, if we're going to close it off, let's specifically look at float. Float is the number of publicly tradable shares available to the public and traders to trade. This is in comparison to the market shares available. Market shares include the float and privately invested shares. The float is just public, and that's the difference. Low float is generally 10 million and under. Low floats are considered more volatile and more easy to move, more tradable. But you get into low floats at your own risk. Long, they can be brilliant. Short, they can be brilliant for different reasons, but they are volatile. But with the mid to high floats, you're looking at more where our traders as bag holders, or where are they as profitable traders? And that's the two different ways you look at them.
All right, and in the next episode, we're going to talk a little bit about time frames. And I think we're going to also talk, if we have time, a little bit about SEC filings and news and sectors and lots to cover. So I'm excited. Thank you for today's lesson, Stephen.
It's okay. I hope I was a good teacher.
You are a good teacher.
God bless.
All right.